Good evening. Welcome to KACPA August 20th webinar. My name is Paul Ju, KACPA Seminar Director. I'm the host and the facilitator for the webinar today. First, let me introduce our chapter president, Justin O, for his opening remark.
Hello, I'm Justin O. I'm extremely proud to introduce distinguished speakers from Hall and Company. Hall is my favorite Napa Valley winery who make a great Cabernet Sauvignon. And what a coincidence. Hopefully our favorite consulting firm we can work with in the future. And they will cover this evening state local tax and R&D credit topics. And I can't believe this incredible event is free of charge. The reason we can do this is because we have a dedicated officers who devoted time and effort to make this webinar event possible. Webinar Director Paul Ju, raise hand, and Jin Kwon, many others. Even if we can charge a fee for this webinar in the future, and I promise you, we will continuously provide affordable and high quality webinar to our members. So I'm strongly encouraging you to continuously register and earn the CP credit in the future. Okay, and also I'd like to mention our YouTube team is diligently working hard to launch our program at the end of this month. I'm strongly encourage each and every one of you to participate in this upcoming programs event. And thanks for the wonderful speakers and attendees of this event, and have a great time. Thank you.
Thank you, Justin. Today's webinar includes two interesting topics: state and local tax trend and federal research R&D tax credit. Each webinar lasts about 15 minutes. There will be about 5 minutes in between the webinar, break in between the webinars. During the webinar, if you have any question, you can type your question in the Q&A window, and I will read them to the speaker on your behalf. The speaker will try to provide the answer as time permits. During the webinar, there will be 4 random polling questions, which you need to answer at least 3 questions for you to receive 1 hour CP credit per session. Total 2 credits for today. Now, let me turn over to Jin Kwon, who is also seminar director, and will be introducing Michael Nunes as a guest speaker.
Hi, everyone. Welcome to our second KACPA webinar. Today, we have 2 speakers from Hall & Company, certified public accountants and consultants. For over 35 years, Hall & Company has been committed to providing their clients with world-class financial advisory services. They're located in the heart of Orange County, which is Irvine, and recently joined as a BDO Alliance, provides an impressive array of advisory services, including tax, audit, research and development, state and local tax, and other industries like manufacturing, software, in addition to cannabis and consulting. Hall & Company has a deep specialty when it comes to research and development tax credits. They have one of the most experienced teams in Southern California, helping hundreds of companies save millions of dollars in tax. Their footprint is small, middle market, family-owned businesses. They also ranked a top 25 accounting firm in Orange County for over a decade. Now, let me introduce the first speaker, Michael Nunes, who will be covering state and local tax trends today. Michael is a former tax partner with McBartley's State and Local Tax Services. He also worked for Deloitte before. He brings over 30 years of experience of counseling multinational and multi-state business, covering a variety of industries such as manufacturing, biotechnology, software, cannabis, wholesale distribution, high technology, and medical device. And don't forget to answer the poll questions during the session. Please welcome Michael Nunes. Mike, the classes all are yours.
Thank you, Jean. I want to make sure that you hear me. Yes?
Mm-hmm.
All right. Today I'm going to talk about SALT trends. We're not going to take a deep dive into nexus or apportionment and sourcing. So here's our agenda for today. We're going to talk about Nexus. What is the trend that we're seeing with regards to Nexus, especially in the wake of the post-Wayfair update and the U.S. Supreme Court in that. We'll talk about income tax Nexus and how Wayfair is affecting states on their income tax positions. And then we'll talk about the relevance of Public Law 6272. Now, with regards to Nexus, it brings up the issue of, well, if we have Nexus in a state, we have to apportion. So we're going to talk a little bit about the single sales factor, the numerator of the sales factor with regards to we use market-based sourcing or cost of performance. And then we'll talk about alternative apportionment methodologies, and we'll take a little deeper dive into throwback, foreign sales, and related issues to that. Given sufficient time, we'll talk about what we're doing with regards to our clients for sales tax Nexus and income tax Nexus. So let's begin. Well, what is Nexus? Well, Nexus is usually disguised as the question, do I have a filing responsibility in the state? Do I have to file a return in the state? Well, in the legal sense, Nexus is a legal term. It's the link that must be established with a taxing jurisdiction before that state can constitutionally impose an income tax. Now, there's different standards for Nexus, or at least there used to be, as you will see from this presentation. So there's Nexus for sales tax, Nexus for franchise and net worth taxes, and also for income taxes.
Mike, I'm so sorry. Are you able to share a screen with us with your PPT?
I didn't realize that. Okay, so.
Maybe Jean, can you?
Yeah, do you want me to share it?
Please, thank you.
Okay, Mike, I will pull it up and I will kind of move it through based on what you instruct me. You can just say next page and I will go back to the next page. Will that be okay with you, or do you want to try sharing your screen?
Well, I indicated screen share.
Okay.
Did that do it?
There you go.
Okay.
Awesome.
All right. All right.
Thank
So
you.
so what we're talking about now, we talked about what is Nexus. You know, it's the disguised question of, do I have to file a return in that particular state? All right. And then I mentioned that in the second bullet here, that there are different standards for Nexus, at least there used to be. So what is sales tax Nexus? What creates sales tax Nexus? And I want to be very specific that we're talking about sales tax Nexus. So for the past 70 years, the U.S. Supreme Court has ruled that really through national ballot test that any physical connection to a state caused a sales tax connection, which meant that that state or that particular taxpayer had to file a tax return. Now I see that a polling question has come up. For sales tax Nexus purposes, do states use a physical presence test or a bright line standard? Now I'm going to give you the answer to this, and that is that they use now a bright line standard. Physical presence is no longer the norm. Now, as I just mentioned, physical presence is now the standard. Therefore, I'm sorry, I made an error there. Physical presence is no longer the standard. We now have economic nexus standard. So this just came about in June of 18. And as a result of this US Supreme Court decision, then it overturned the physical presence test that was formerly required. Now that we have a bright line test, all right, that bright line test under the Wayfair decision says that if the only thing that a taxpayer has, a seller, has in the state is $100,000 of sales or more, then, or 200 transactions, they have an obligation to register and file a sales tax return in the state. Now, this is really for what we call internet sellers. However, the Wayfair decision has far-reaching implications more than just for sales tax. Presently now, most states have legislation that now has requirements that any remote seller now register and file a sales tax return if they meet these bright line tests. Now, here's the issue though. Most states like South Dakota, the requirement for the bright line test is $100,000 in sales or 200 transactions. However, many states like Connecticut, Massachusetts, it is disjunctive. It is and, which means they have to have $100,000 of sales and 200 transactions. Moreover, the sales thresholds under the South Dakota decision is $100,000 more in sales. But some states like Alabama, Connecticut, Georgia, it's merely $250,000. Massachusetts and Tennessee, it's $500,000. And in New York, it's $1 million. Yet even in other states, Pennsylvania and Oklahoma, it's merely $10,000. So the point that I'm making is that while Wayfair is the law of the land, not all states are applying it equally. Even the enactment date in 2018, in June of 2018 or thereafter, a handful of states passed legislation because it was already on their books waiting for the Wayfair decision. In 2019, however, most states then came aboard to pass their Wayfair statutes. And as late as just 2020, this year, Louisiana just came on board. So to the extent that we have clients or you have clients that are now obligated to file returns for sales tax in the various states, there are many, many different enactment dates. And you have to be very, very wary of when you start filing and quantifying your past exposure. Now, how has Wayfair impacted many industries? Well, obviously, I just mentioned e-commerce, but even sellers of just services, wholesalers, cloud computing companies, software as a solution. We have many clients that are in that area of practice. Wayfair is impacting them as well. Wayfair has even gone now and impacted types of taxes. The most important tax now being income tax. Some states have begun to adopt the Wayfair bright line test for state income taxes. A state in point, Hawaii, specifically amended their state laws to say that they are adopting the Wayfair sales tax nexus as their income tax nexus standard. They're the only state that has done that thus far. All right, part of my presentation involves the Bloomberg survey. Bloomberg is like CCH or RIA, and they have a national survey that they send out every year to state administrators that allows them to answer questions posed by Bloomberg. This is one of the surveys from this year, 2020. And this is showing what are the trigger points for Nexus. So in the center, you see post-warranty. That means that any seller who has no presence in the state, but uses third-party providers to do the warranty work on, say, the repairs of computer monitors, that would create a taxable presence and create nexus in the state. Merely registering to do business in many states triggers nexus. Nexus for purposes of the franchise tax or paying minimum tax and so forth. And some states even have de minimis provisions that say, hey, even a minimal connection is enough to create a taxable presence in this state. All right, our next polling question. Income tax nexus is solely based on the presence of property, payroll, and sales. Is this true or false? Well, we're only getting into the income tax nexus now, so I'm going to answer that question for you. And it's false. Income tax nexus is based on a number of other factors as well. All right, so what creates nexus for net worth franchise tax? Well, I just mentioned in the previous slide that mere incorporation, mere registration, merely getting a license in a particular state gives you a nexus. It may be sufficient for purposes of creating a nexus to that state. Certainly, you're all familiar with California. If you incorporate or register with the Secretary of State, you are now required to file a return and pay the minimum franchise tax, even if you don't have any other activity. All right, there are safe harbors, though, for franchise tax and net worth taxes. So what are some of the things that you can do in a state that won't rise to the level of a nexus? Well, defending yourself in a lawsuit. You may have a customer in the state where you're not otherwise physically there that sues you for maybe defective use of product or something of that sort. That doesn't create a nexus to the state. Having a directors or shareholders meeting in a particular state, especially a sunshine state, where maybe you're engaging in a golf outing, that doesn't create a nexus. So there are a limited number of activities that don't rise to the level of doing business, but you are physically there in that state. Okay, let's get into the area of alternative taxes. Many states now have taxes that are based on other than net worth. For example, in Texas, we have the margin tax. In Ohio, you have the commercial activity tax. Michigan has the MBT tax, and Washington, the business and occupation tax. What is the level of nexus for these states? Do we apply the same standard? Well, probably the answer to that is yes. It would be very safe to assume that if you have a sales tax nexus, if you have a franchise tax nexus, you will have nexus for purposes of the Texas margin tax or the Ohio alternative tax. All right, here's another Bloomberg survey. And what this is showing is that 6 states presently still have physical presence requirement, which says that you have to have physical presence to be subject to their income tax. I suspect that over time that will change. 32 states have economic nexus presence, which we will get into, and then 13 states have the factor presence bright line test. And we will get into a discussion of that as well. So now we are migrating from sales tax to income tax nexus. All right, I mentioned the factor presence test. This Bloomberg survey shows how many states and how the states are migrating towards conformity to a factor presence test, which is a bright line, test. All right, so what does create income tax nexus? Many states have an economic nexus standard. It means that there is am I doing business in this state? However, these economic nexus standards really do not rise to a level of a bright line test. So 38 states currently have this type of income tax nexus. This began many years ago in 1992 with Jeffrey's decision out of South Carolina. This is where you had an intellectual property holding company based out of Delaware. Its nexus was limited to the state of Delaware. However, Jeffrey was collecting trademarks on Jeffrey the Giraffe, which if you have children, you're familiar with. It's Jeffrey the Giraffe, that is the logo on the Toys R Us stores. And they were collecting a stream of trademark revenues from the various states that Toys R Us did business. The Department of Revenue assessed the Delaware Holding Company for having nexus in their states because they were deriving income from the licensing of that intangible. Long story short, the taxpayer lost, and hence we now have nexus standards that tax merely the employment of an intangible or intellectual property in a state where the taxpayer is collecting a revenue stream. So this is where it began that a physical presence was no longer required. All right, now, to put this into perspective, California has been way ahead of many, many other states. They not only having a doing business standard, they also have a factor presence test. This is what I mentioned earlier before. This is where you have a bright line test that determines that you have nexus merely for the fact that you have payroll in the state, a dollar value, or sales in the state, or property in the state that exceeds even a de minimis amount. So California, as well as a number of other states, now employ this factor presence test. Now, as I mentioned, and it's always been true, that anytime a company or their employees or their representatives perform a service in this state, do repairs or installation, even if they do these activities through a third party, an independent contractor, it would appear now that that would create the income tax nexus. There really is no longer a de minimis presence or activity that would shield a company from having an income tax nexus. Now, all of that said, there is a law, a congressional law, by the name of Public Law 86-272. This law came about in 1959 because states were seeking to tax any corporation or any business that had any activity in their state. Well, Congress wanted to limit the state's ability to tax any activity in the state. So Public Law 86-272 was passed, and it essentially said that if a company limited their activity in the state to merely asking for the solicitation of sales orders and nothing more, that they were immune from a state's income tax. Well, in light of economic nexus standards today, is Public Law 86-272 even relevant? I dare say, yes, it is. However, Public Law 86-272 only applies to sellers of tangible personal property. If you are a seller of services or software as a solution, Public Law 86-272 does not apply. Now, what about telecommunicating? This Bloomberg survey went out because in today, many businesses that are service providers do not have a workforce in the office. They have a workforce that is spread throughout the states, especially if they provide services. So this is a trend, and no doubt having an employee in the state will continue to create the income tax nexus. Now, in view of COVID-19 this year, many states are now finding out that they have employees in states that heretofore were not present in the state, especially back east where the state boundaries are so much closer. Many states are not asserting that because of the temporary workforce due to COVID-19 that is creating an income tax nexus. However, many other states have not ruled on that. So you must be careful when you start to find out that your clients now have a workforce in states where before they did not. I would be more conservative and not automatically conclude that nexus has arisen in a particular state due to COVID-19. All right, and here's a Bloomberg survey that shows where the states are on this. Many states, like I said, don't have any guidance, but this is kind of giving you a snapshot that where we are currently with this trend. All right, well, how do we identify nexus? Well, essentially this means, oh, we have another polling question. All right, of the three apportionment factors, property, payroll, and sales, which factor is most favored by the states? All right, state apportionment requires property, payroll, and sales. However, what factor is most favored by the states now? I'll help you with this one. It's the sales factor. So continuing on now, where do we get an understanding of our clients' activities? We now today have to know completely what our client does. How do they do their business? Where do they do their business? What I usually do is I get online and I look at a client's website. This is where they hold themselves out to the public as to what they do and where they do it. And it is surprising to me how much information I get from their website so I can completely understand our clients' way of doing business. State tax notices and so forth. Does your client receive these? If they're getting a notice from a state, the state has some information that says they suspect that they may be conducting some kind of activity in the state. Clients now are getting into new lines of business, dropping old lines of businesses. We need to be on top of that and understand what their new lines of businesses are. Presently now, when I request information from a client to do their corporate returns, I'm actually asking for sales based on customer location. I want to know if they have internet sales. Do they have separate sales on Amazon and eBay? Because so many of our clients now do sell through the internet. All right, that takes us into apportionment and sourcing now. So now that we know that a client may have nexus in a state, how do we apportion the income to that state? So state apportionment is done by formulary apportionment. It's composed of three factors: property, payroll, and sales, computed as a ratio of the amount of business that they do in a particular state. Today, though, states are migrating away from a three-factor formula and going to more of a heavily weighted sales factor. So this is the latest trend now, and in fact, many states have begun to use a single sales factor. So this Bloomberg survey is showing you that, not so many years ago, just a handful of states used a single sales factor. Today, there are many, many more states that are using a single sales factor, and many states are still coming on board to emphasize a single sales factor because that is more of a reflection of the level of activity that businesses conduct in a state. And the sales factor actually results in a higher apportionment percentage to the state, thereby having a higher taxable income in the state and more taxes for the coffers of the Department of Revenues. Now, I mentioned a sales factor, but there are many states that do have special apportionment formulas for other than the sale of tangible personal property. This next Bloomberg survey shows that with regards to a company that just has licenses and leases for like intangibles, like in the Jeffrey decision that I mentioned, or they're just a service provider, or they do cloud computing, that many states have now migrated away from the three-factor formula to special formulas. And most states, as you can see in the blue highlighted area, that they're using what we call a market-based sourcing rule, as opposed to a cost of performance rule that is shown in the purple bar. All right. Now, I need to draw your attention. Oh, we have another survey here. Market-based sourcing for receipts is based on customer address or benefits received. Well, we're getting into the market-based sourcing rules right now. So I'm going to tell you that we, for market-based sourcing, use both customer address or benefits received, depending on the information that's made available to us. All right, so when we compute the sales numerator and we have determined that our client is a seller of tangible personal property, we actually have to know the sales from the various locations that our client ships from. If they ship from California and they ship from Tennessee, we have to have a sales report that says, here's the sales out of each location. Today, many clients also ship from China or for Korea. We also have to know the amount of sales that they are shipping from those locations. If they are shipping from any location to a foreign country or a foreign destination, we have to have that sales data as well. Now, for our clients that sell service revenues, there are cost performance rules or market-based sourcing rules. So now we're going to talk a little bit about that. This is the new trend that states are migrating towards. All right, so in terms of cost of performance, this is a sourcing rule that says, based on that revenue stream that's produced in the state, where is my cost located that generated that revenue? Is the cost back at the home office, or is the cost incurred at the customer site? Say they're a service provider. Are they doing the servicing at the customer site or back at the home office, or are they doing it in both places? Some states have a greater cost. If the greater cost is at the client site, because that's where the payroll is being incurred, 100% of the revenue stream from that contract or that customer is assigned to the state of greater cost performance. If the greater cost is back at the home office, then it's assigned not to the customer state. Other states have a cost performance rule that is pro rata, which means they are going to split the revenue based on a time spread method, or based on 60% is at the customer site, or 60% is back at the home office. So we're going to find out that many states have a cost of performance rule, but they're not applied equally.
Mike, we have one question from the audience that one of my clients is selling products to customers in all states of the United States through internet sales. Does this company have to file income and sales tax return in all states?
Well, the easy answer to that is depends. First of all, we'd have to determine that if they're a service provider, what type of service are they providing that might subject them to a sales tax nexus. For example, if they are if they're a provider of software as a solution, many states subject that to a sales tax. And in the states where that is a taxable service, yes, they may meet the requisite for sales tax and have to charge their customers the sales tax. However, on the income tax front, they would first have to meet the state's income tax nexus requirement, which, as I just described, could be a factor presence test or an economic presence test. So it really depends on the level of volume of sales that they have in the state for income tax purposes. And then for sales tax purposes, there really would be no standard like Wayfair. The mere fact that they are engaged in an activity that requires a sales tax, they meet the nexus standard. They should be collecting tax and charging their customers tax on that type of service. All right, continuing on here, market-based is the latest trend. And this really is based on where the customer receives the benefit for the services that they bought. So this really applies to clients who are selling a service. There are many complexities with this market-based. So 20 states now have migrated to market-based sourcing. However, again, not all of the states have come on board at the same time. Many states beginning in 2014, other states just more recently coming on board. So what is market-based? Well, for California, as well as most other states, the easy definition says sales from services are in this state to the extent the purchaser of the service receives the benefit of the services in this state. Well, that's an easy definition. So if you are providing software solutions and your customers are in 13 states, one could argue that the customer who bought your services in a particular state, that's where they are receiving the benefits of your services. However, if that customer in a particular state has 4 locations in 4 other states, the benefits received are in a total of 5 states now. So how do you do the sourcing? Well, states have what they call cascading rules. California is in front of most other states in defining these cascading rules. Essentially what it says is, we're going to look at how you're booking your revenues. That's the first place that we're going to determine where the revenue is assigned to the state. A good example is Walmart. You have a $1 million contract with Walmart. You bill Walmart out of the state of Arkansas. That's their corporate headquarters. However, this $1 million contract is earned by each store in a state that Walmart operates. One would then argue under the cascading rules that the benefits received are in each of the states that Walmart has a store. And that's how that revenue should be booked. And that's how any revenue agent, if you were subject to audit, would want that revenue to be assigned to each of the states. So it can be very complex. Now here's another Bloomberg slide, and what this is showing is that states do have a methodology if the formula does not accurately project your level of activity in the state. So if you can see in the center of the purple bar, some states allow the party who's seeking a different formula the burden of seeking the proof that it is more reflective of the activity in the state. Others put it directly on the taxpayer, as you can see in gray. Many other states have a protocol that says, submit us your formula, we'll review it, we'll see if it makes sense and if it's reasonable. So not all states have special formulas for like motion picture industry or financial reporting such as banks. So many of these industries can petition the state for a special formula or a formula that reflects their activity. All right, let's talk a little bit about some of the very narrow issues with regards to how we calculate a state's numerator. For our clients that sell tangible personal property, there's something that we call a throwback sale or a throwback rule. However, 26 states do not have a throwback rule, which creates an opportunity to report sales legitimately to nowhere. So let me give you an example. You have a California taxpayer. They have a factory that they ship from in California. They sell to Tennessee, a customer there. All right. Under the sales factor rule, the sale is assigned to Tennessee. However, it doesn't rise to the level of creating a nexus in the state of Tennessee. Under California's throwback rule, you would throw that sale back to California and include it as a California sale. Now let's look at another state. Let's say you have a factory in Tennessee. You ship to New York. Because Tennessee does not have a throwback sale, the only sales reflected in Tennessee are sales to Tennessee customers. Any sales that come out of a Tennessee warehouse to any other state are nowhere sales until that seller in Tennessee meets a nexus standard in another state. So legitimately, we are creating nowhere sales. So it's very important that you understand the states that have a throwback rule or don't have a throwback rule, and where your client is shipping from. All right, I just mentioned this, so I'll just move along to the next slide here. All right. So, in summary here, it's very important that we understand our clients' business operations. And as I mentioned, getting on the website and understanding what it is they do and how they do it is going to allow you to make a decision whether or not your client has a nexus in the state. With regards to nexus, we've determined that there are many different standards and various dates that they have determined that, that they meet the Wayfair test, that they meet the factor presence test. And if you ever have to do a VDA, a voluntary disclosure agreement, because your client was a non-filer in the state, you know, we have to look at the enactment date to determine how much tax is at risk. In apportionment and sourcing, the sales factor is clearly the most important factor. We need to get it correct to file our tax returns correctly and mitigate the client's sales tax, or I'm sorry, sales factor. Market-based sourcing versus common cost of performance sourcing. The difference in application truly matters, and it makes a difference when we are preparing these returns. You need to do your research to find out what is the appropriate methodology to use. With that, I want to throw it out to some additional questions and answers and share with you what we are doing in terms of our clients and trying to get our arms around their nexus.
Thank you, Michael. Appreciate your expertise and knowledge. We have a couple questions from the audience. That the following question asking about, beside California, the client has a website, they station in California. So when they ship out their products to in the United States, in your own experience of 30 years, which states are most heavily audited states?
Well, the way I would approach that, the most heavily audited states would be the states that are most marketed states. For example, every seller wants to sell to customers in California. So California is heavily audited. State of Illinois, state of New York, state of New Jersey, Ohio, increasingly more some of the southern states are big targets because those are our new market states. If you look at where the population demographics are moving, the Sun Belt states, a lot of manufacturing moving there, and those Department of Revenues are examining companies that are moving to their states or companies that are heavily selling into those states.
Thank you. We cannot stress enough about the role of Amazon. So specifically, the Amazon Fulfillment Center. So as a tax client, what is your opinion and guidance dealing with using fulfillment center in Amazon?
Well, from a sales tax perspective, Amazon is now required to collect sales tax on behalf of the seller. What that does now for the small remote seller or any clients that sell product through Amazon, it relieves them of the sales tax burden of preparing sales tax returns and remitting. What it doesn't do, though, is to the extent that they also sell on their own website, they now have to be very cognizant of meeting the Wayfair standards of $100,000 or more in sales, and then filing tax returns on their own. So many of my clients, where they sell on both their own platform and on Amazon, they're not concerned about the Amazon sales. Amazon's taking care of that on their behalf. They're now concerned about their own direct sales. So that's on the sales tax front. On the income tax front, what Amazon fulfillment warehouses do for clients now, to their chagrin, is that having inventory in a state creates a physical presence. Although physical presence is no longer the standard, we have a lower standard economic presence. Having inventory in a state creates nexus. So if you have consignment inventory, if you have inventory in an Amazon warehouse, you have nexus in the state now. And I don't know that many taxpayers realize that. Now, I have other clients where they actually sell to Amazon, and now Amazon has inventory in the state, but it belongs to Amazon. So from an income tax perspective, they've sold their inventory and it's now Amazon inventory. And so that wouldn't rise to a level of nexus. So fulfillment warehouses, for the most part, can create the income tax nexus, and those sellers have to beware.
Okay, thank you so much for your wealth of knowledge. I have many questions, but I would like to, do we have your email in your presentation?
I'm sorry, I did not include that in my presentation, but it's michael@hallandcompany.com.
Okay, well, thank you so much, and appreciate your expertise and knowledge, and your bringing everything a little bit more understanding. So we're gonna take about a 7-minute break. So I'm gonna let Michael go. So we'll be ready for our next speaker. So thank you, Mike, for your presentation.
Thank you.
Good job, Mike.
No, I got the wrong presentation.
Welcome back. Do you hear me?
Yes.
Okay, great. Okay, welcome back. We are starting a second session for today about Federal Research and Development Tax Credit, R&D tax credit. So now let me turn over to Jean Kwan, who will be introducing Lucia Valenzuela, and she's a lawyer, tax lawyer, and very pretty.
I agree.
Thank you.
As a next guest speaker. Thank you.
All right, welcome back everyone. Let me introduce our second speaker, Lucia Valenzuela Esquire. She will be presenting identifying and monetizing the Federal Research and Development Tax Credit today. Lucia is a senior manager of tax specialty consulting at Hall & Company and is licensed to practice law in the state of California. Prior to joining Hall & Company, Lucia worked at KPMG and Moss Adams and as a tax lawyer in a private law practice. Her practice focused on helping clients identify and substantiate R&D tax credit. She has extensive experience in various industries such as software and technology, manufacturing, cosmetics, agriculture, and life sciences. Once again, don't forget to answer your poll questions. There will be 4 poll questions during the session. Please welcome Lucia. Lucia, please start whenever you're ready and please share your PPT with everyone.
Sure, thank you, Jean. I'm gonna go ahead and share now. Perfect, looks like it worked.
Yep.
All right, well, thank you so much for having me, Korean American CPA Society. I really appreciate you guys spending your evening with me. If there's one thing that I've learned through this whole COVID thing is that the time that we spend with our family is truly precious. So hopefully right after this, you guys are having dinner with your family or doing something fun. So I'll try not to take the whole hour, but I might. So as Jean mentioned, I specialize in research and development tax credits here at Hall & Company. And basically what I like to say is that I have the best job in the room at any given time. All I do is find clients money and help them save money on their taxes. So it's a really fun experience for both me and the client. From this presentation today, I'm hoping to leave you guys with a general understanding of the R&D tax credit rules, with the ability to identify potential challenges associated with the credit for your specific clients and potential solutions. My email address is not included in the slide deck, but I can definitely have Jean send that out, and I'm available at any time to walk through any scenario with your clients or help you figure out if this is a good benefit for your clients. So in terms of the agenda today, there's a few slides related to the introduction. We want to also go through what the qualified research expenditures would be and activities. So one of the things that I want to keep going back to in this presentation is that there's 2 different things that we have to establish in order to take an R&D tax credit for our client. And the first is, was there actually expenditure? So do we have the financials to prove that there was an R&D activity happening? And then the second is the activities themselves. Do we have enough substantiation for the activities themselves? So I like to think about these things as QREs on one side, qualified research expenditures, and QRAs on the other side, qualified research activities. We'll also be going through the computation of the R&D tax credit and then what the field work looks like, documentation for substantiation, and then this is a little bit of an older topic now, but after 2015 there was some changes to the R&D tax credit rules, so we'll be reviewing those to see if those open up any opportunities for your clients. So hopping in here, the credit itself is called the Research and Development Tax Credit for increasing research activities. So the increasing is the operative word here. If you have a client who's been doing the same thing for a number of years, not increasing their payroll, not increasing their expenses, and not really putting money into innovation, the chances that you're going to have a credit or credit that's worth going after are very small. However, if you have a client who's constantly innovating and who's spending a lot of time and money hiring more employees, hiring employees with better, more technical job titles, then likely you will have an R&D credit for that company. The increases are compared to a base period. So at a minimum, if you do a R&D tax credit for year one, you'll have to look at least 3 to 4 years of historical data, because you have to build a base period in order to figure out what your current year opportunity would be. As most of you know, because you're CPAs and I'm not a CPA, the credit is worth more than a deduction. So we like to emphasize this with clients. It's one of the few ways left to actually get a credit dollar for dollar off of your tax savings. Here at Hauling Company, we do work with a lot of family-owned businesses, and we have tons of clients for the S Corp deadline coming up. They love the credit when they're able to take it, because that credit flows through to their personal returns and they're able to see the dollar for dollar savings. The PATH Act did introduce some additional opportunities for smaller businesses. So I came from the world of KPMG, where the Fortune 500 take this credit and they don't blink twice about it. And the reason they do that is because they have the resources and the capability to pay for the credit. However, what always happened was you would see the smaller companies who actually needed the credit, they wouldn't be able to generate enough revenue, or they wouldn't be able to monetize the credit. And so now, after 2015, what has happened is a lot of smaller companies, startup companies, companies that are actually in positions to use the cash flow that the R&D credit creates, are able to actually absorb that. So it's great to see that there's been some changes. Over time, the credit has become more challenging, and there is so many, let's see here. There are so many cases that have come out. There are, we'll say, good R&D providers, and then there are the okay R&D providers. And what has happened is that there has been a lot of claims for R&D over the last 10 years, and some not so good, some good. But what that's done is created a lot of tax cases at a court level. And we've had some favorable tax decisions, and we've had some non-favorable tax decisions. So now, instead of it just being code-driven and regulation-driven, we also have tons of tax law that we have to look at, and tons of case law to review on various issues. A really good marker to see if your client may be able to take an R&D opportunity is to think of the qualifying expenses that may be there. And back of the napkin, 7.9 or 8%, I like to use 6% to be conservative, of those expenses would be the credit or the net benefit that the client may be able to get. So with any claim, there is potential risk, but especially with the R&D tax credit, there are some risks to going after that for your client. So I would suggest that you first have a conversation with your client about their risk appetite, and I do this every day, on positions and specifically on the R&D credit as a whole. So some of the potential risk factors that you may think about are the amount of the credit. So obviously, credits that are in the millions or hundreds of thousands are going to be, more eye-raising than the ones that are smaller, under $50,000. You want to think about what you're doing in terms of filing the credits on originally filed returns or amending. We always tell our clients, if you file an R&D tax credit on an originally filed return, it does not increase your chances of audit. It's not a red flag. It's just another thing that you're putting down on your tax return and doing your due diligence. However, if you amend returns, especially if you're asking the IRS or your state body for a refund, what's going to happen is they're going to want to know why you are due this refund, and they're going to ask you to prove it. So just keep that in mind. Yes?
Sorry, is the page supposed to move to the next page? I'm getting questions that the page is not moving forward, or are you just reading the introduction?
Let's see. Oh, I'm sharing. Am I sharing my screen? Let's see. Let's see here. Okay, now we're on the same screen. Let me just, yeah, let me escape out of this guy and see if I can't. There we go. All right, is that better?
Yeah, we're at the potential risk right now. Is that what we're
Perfect.
supposed to see? Okay, cool. Thank you.
Yep. Okay, so amended returns are going to draw more of a risk than timely filed returns. The expenses that are claimed within the R&D credit might also be potential risks, and you really want to pay attention to the activities that the client wants to include as R&D, and really know your clients in terms of documentation. Time tracking, I would say, would be the best thing to use if the company has time tracking. However, a lot of time, the time tracking is more like project management, and so it's not really reliable. So you really want to understand, what the client has in terms of substantiating documentation. Are they organized? Is their GL cleaned up? A lot of times we get involved when there are mergers or acquisitions happening. And what happens is one company comes into the merger with really great documentation, and the other company comes into the merger with very bad documentation. And in that case, we really have to assess the risk for claiming the credit, especially if the numbers are high. Not sure what's going on here. There we go. So in every R&D study, there are a certain number of steps that need to be taken, and we think about this as a study approach. But basically, the first thing you have to do is identify a potential benefit. Can my client even qualify for R&D? Hopefully after this hour, you will be able to do that on your own. But if not, you can always call somebody who knows, or call one of us. But basically all this requires is, are they doing the activities that could potentially be research and development for tax credit purposes? Phase one of the study would be estimating the actual credit potential. We do this so that we know the amount of work that's going to go into the credit, but also so the client knows what to expect. Typically, on an average mid-sized company project, we're looking at least 5 hours of somebody's time at a company. So it's got to make sense from a numbers perspective and from their time perspective. So we do this and we gather some initial documentation. It's usually very high-level financials, general ledgers, wage data, tax returns, very basic. Once we establish that there is a benefit and we go through this analysis and the client is ready to move forward, we go into phase two where we perform all of our field work. So what this looks like if you're filing the credit for your client would be gather all of the rest of your financials. So you would need wage information, and we'll go through that later, what types of financials you need. And then also identify at least 2 to 3 technical personnel within the company. What happens a lot of the time when you're filing an R&D credit is the CEO or the CFO wants to take the lead and they want to do the credit themselves or help the person filing the credit get the numbers together. But what happens from an IRS perspective is the IRS will say, well, how does this CFO or CEO that's not even involved in the day-to-day activities actually know what's going on? And is he involved in the actual projects, or she involved in the actual projects? If not, they're less likely to take the word of the CFO. So you always want to identify at least one technical person at the company. The next thing you want to do is try and figure out what type of documentation they have. Do they have a documentation repository? And gather that documentation for support as well. After phase two, you'll have the credit forms, which I'm sure a lot of you guys are familiar with. You take the credit forms and you put them in the tax return, and then what happens? Well, there's this whole other part that happens, and if you've ever worked with an R&D company or somebody helping to, file an R&D claim, you'll notice that the numbers come first. So the forms will come in this form of an email or something, and then about 3 or 4 months later, there's a report that magically shows up. That report is actually all the due diligence that has to do with the credit itself, and that report's very important. So some people will say keep that for 3 years. I would suggest keeping it for the life of the company, just because you never know what's going to happen. And there are situations like I'm dealing with now where 11 or 12 years later, you have to look back to a study that was done 10 years before. So it's very important to just keep all of this stuff. And that's, I think, with anything in terms of filing positions, the name of the game with R&D is how much support do you have? In terms of industries that are able to take the credit, they are far and broad. So my favorite is cosmetics. 1, because I'm a consumer. 2, because there's usually a lot of ladies at cosmetics companies. But 3, and most importantly, they always give you swag, and they always leave you, thinking about what you're using, and as a consumer, what you're putting into your products and your body. So I love cosmetics, but here at Hall, we do software, manufacturing. I would say probably 50% of our book is manufacturing in all different types of industries. I have worked on almost every industry: agriculture, autonomous cars, power and utility was a really big industry a few years ago. Like every single utility company in California claimed an R&D credit. But pretty much anything you can think of, especially nowadays, they are investing in some sort of software, or they're invested in some sort of R&D. And we'll get into how that works. Okay, So this slide is probably the most important. So when we talked about QRAs, qualified research activities, this is the backbone to R&D. And maybe some of you have heard this before, but the 4-part test. So R&D comes out of IRC code 41 and 174, and you can boil down all of that code section into these 4 parts. And if you can satisfy all 4 of these parts, then likely your client will be eligible for a credit. So this test has to be satisfied both on a employee level and on a job level. So just keep that in mind. But the first part of the test is the permitted purpose test. So what this means is your client has to be involved in a new or improved product, process, formulation, invention, software, or technique. So I call that PPFIS, product, process, formulation, invention, software, or technique. What that means is if your client's doing any of these or investing any money in any of these, there's a potential for R&D. Now, the activities that they're involved in have to increase the performance, reliability, or quality of that product, process, formulation, invention, software, technique. So very easily, products are, very easy to figure out. Are you inventing a product? Are you developing a new product? Okay. Process is a little bit unique to the company. Are you involved in a process that increases your performance, reliability, or quality? With manufacturing, usually companies are undertaking performance improving projects or internal projects as they define them every year because they want to make more money. Formulations are things like cosmetics and, we have a company that does like nutritional vitamins and things like that. So formulas, this is what people typically think about when they think about R&D. They think about a scientist and a formula. So that one's pretty slam dunk. Invention, there is a safe harbor rule for a patent. So if your clients are involved in any type of invention and they have patents or patents pending, that's a really great fact for R&D. Software is a funny one and it's very unique. There's been a lot of changes to software and we'll talk about those a little bit later, but basically software now is booming. After 2015, there was a presumption that got reversed that not all software is internal use software, meaning the IRS used to think about software like it's not innovative, you only use software to improve your internal processes and there's really nothing that you are doing that's innovative. They have since figured out that software is a very technical area and requires engineering and schooling and a lot of different programs, and there's so many program languages. And as software evolves, it gets more complicated. And now we have SaaS and we have companies developing all kinds of software. So the IRS has gotten smart and they've reversed the presumption, and now software is looked at as being research and development for the most part. Technique is the one that's always a little subjective. So technique is what you want it to be as long as it increases the performance, reliability, or quality. So that's the first part of the test. Now we've satisfied that the client is involved in a new product or process, formulation, invention, software, technique. We move on to technological in nature. So here's where we throw out all of the marketing companies. We throw out companies that aren't involved in technological activities, and we only look at companies that are involved in hard sciences. Computer science for software is a slam dunk. Engineering, chemical engineering, material science, anything that has to do with the hard science, and we don't think about soft sciences. So if your company can't establish this technological in nature requirement, then they don't move on to the next step. If they do, however, we look at part 3 and part 4 of the test together. And the reason we do that is because part 4 of the test explains how you overcame part 3. The third part of the test is technical uncertainty. So we have to establish that within the activity that the client was doing, there was some sort of technical uncertainty that they encountered. That technical uncertainty can fall into 3 categories. Design, which is the weakest. So the client will say, I didn't know what the ultimate design of the software was going to be. That's design. Capability, can we actually do it? The client will say, I don't know if I'm capable of doing what I'm trying to achieve, but I'm going to try it. I'm going to undertake an R&D process to try and see if I can develop whatever I'm trying to develop. And then the last is method. I have 17 different methods that I can use to create this product or process or software. Which one am I going to use? So that's the uncertainty. We have to establish that there was some sort of technical uncertainty related to capability, method, or design. In order to solve that technical uncertainty, the client has to have gone through a process of experimentation. Here's where I think sometimes clients get bogged down in the technicalities and they think that they don't qualify because this sounds very scientific. But the bar is not set that high. All we have to show is that the client undertook a process of experimentation and evaluated one or more alternatives to overcome that technical uncertainty. Now, the project doesn't have to succeed. Whatever they're trying to develop doesn't have to succeed. There's no requirement for that. But all four of these points have to be established within those activities for a client to have R&D. In practice, what this looks like is we always have to start with a quote unquote project list or some kind of initiative list that the client worked on. For software, it usually generates out of their agile sprint software or the activities that their employees were tracking time to, but somehow we have to get to a project list. For products, it's what are the new products that you developed or how did you improve your existing products. For formulas, it's how did you improve your formulas. I was working with one of my cosmetics clients today and they were improving one of their formulas to make it organic. And talking to them, the whole point of this project was just to make this product organic and organoleptic, which means using all 5 of your senses. This is a good product. And that was what they took R&D on this year. So again, the bar's not set very high, but you have to establish that all 4 of these things are there. And that's why I call this the backbone of R&D. There are some activities that are specifically excluded, along with activities that are not technological in nature, like surveys, studies, market research. Activities that are boots on the ground outside of the US do not qualify. So with software companies, you see a lot of times they're paying developers in other countries, and that would not qualify. The time that folks in the US travel outside of the US does not qualify. So the test is boots on the ground in the US. Duplication and reverse engineering is also not qualified. So I recently looked at an opportunity for a company that was developing eye drops. However, they were doing it for like CVS, Target brands. And what they do is they essentially would take like a Visine off of the shelf and then they would reverse engineer it to try and create the exact same product. Once they had the formula, reverse engineering, all it was developing that formula over and over again, so into production. That doesn't really meet the 4-part test because it's more reverse engineering and duplication as opposed to new R&D and new product development. Now, the rule is not that the product has to be new to the world. The product only has to be new to the user or the client. Yes, Paul?
Okay, we have a question from the audience. It says, what about changes for a new norm? We are dealing with a pandemic era. All cost of changes and advancement, including all management, salaries, planning changes dealing with pandemic, considered to be R&D cost, subject to credit? If so, what extent?
Got it. So if I'm hearing the question correct, it's what internal process improvements would qualify for the R&D credit. So that analysis is really going to hinge on the technological in nature test. So if it's a new process and it's helping to minimize expenses and there's some sort of tangible process that's being implemented, you have to think about, is it technological in nature? Are you developing software to make your business more profitable? What are you doing? So that question is really going to depend on, is the activity that you're undertaking technological in nature? Okay. And I'll tell you, a lot of my clients that are doing that type of work right now, they're really doing it from like an invoicing perspective, a CRM, a customer retention management. They're trying to increase their productivity so that they can reduce their overhead. And that type of work may qualify, but you have to look at it on a project-to-project basis.
Next one is, what about the business who has manufacturing facility in foreign country and R&D staff is here in the United States? Are they still prohibited from possible credit subject? And then the follow-up question was, when is the best time to claim R&D credit? Is it during the year or is it during the filing tax return?
Okay, so I'll answer the first question first. So the short answer is yes, that client is in luck. So the rules don't state that all of the life cycle of development has to be done in the US. We only exclude the activities that are done outside of the US. So for example, if you're developing a product and you do all of the design work here in the US, you do all of the material specifications here in the US. And this happens a lot with our manufacturing clients who use like China manufacturing. So they will design everything, do all their material analysis here, do their CAD designs here in the US, and then they'll send their designs to China to be manufactured. Usually there's a prototype that's manufactured, sent back to the US. That prototype is then tested in the US. And then finally, once the product is signed off on, it goes to China for manufacturing. Now, in that case, you take all of the expenses from conceptualization, design, testing in the US, and then you exclude anything having to do with manufacturing itself. In terms of the second question, that's the $1 million question. So the time not to file an R&D credit is 1 week before the deadline, which for some reason people love. So this week and next week, I'll get 2 or 3 requests to do an R&D credit by 9/15, and the CPA will be asking me for numbers like 9/14. So that's probably the worst time, but we can still do it. The best time I would say is once the year has closed. And the reason I say that is because not only are your financials done and complete, but most of the time people remember what they did in January, in like November or December. They don't remember what they did in January of the last year in November of the following year. So basically you want to try and get into the R&D credit as soon as possible after your books close before you can file on your timely file return. Okay. The other category that's excluded is funded research, and we will get into that in more depth a little later. Oh, next, actually. So funded research is excluded because the thought is that the taxpayer itself does not retain economic risk and rights to the whatever they're developing. So this is kind of funny. I've had a chance to work with one of the women who wrote the R&D tax credit regulations, and her theory on this is because the government doesn't want 2 companies to claim the same credit. So the thought is if you stop the person who's being funded from claiming the credit, only the person funding the credit can claim it, and you won't have duplicate claims. Now, it doesn't really work out like that in practice all the time. You can have shared rights, shared economic risk, and usually that's what you see. So I keep saying this bar is held low, but what that really means, and I'll say this because I am an attorney by background, is there's tons of gray area. You really have to know your clients and their risk for appetite. If you have contracts where you have established that your clients have some rights to the product or process or whatever is being developed, then I would say take a double look at that and see if maybe that could qualify. However, if you have contractual obligations to the person who's funding you and you are giving up, or your client is giving up all of the rights to the software, to the product, to the process, to the formulation, you're likely not going to qualify for the credit. The service does come down pretty hard on this. So if you go through an audit and you have risky contracts, that's just one thing that you might want to flag. Basically, what economic risk will mean is that the taxpayer who's claiming the credit is at economic risk of failure. And what that means is if we don't develop what we're trying to develop, we're going to be out money, time, energy, whatever it is. So for example, in my cosmetic client, because it's fresh on my mind, if they don't develop this organic lotion and organic formulas, what's going to happen to all the time that they put into the project? It's wasted. They have now incurred economic risk. In terms of rights, the test is, does your client retain substantial rights, which is a little misleading because the rights aren't actually, they don't actually have to be substantial like you and I would think of the word substantial. You only have to retain rights as far as know-how. So there are some industries that are a little bit more gray than others, but we see this a lot in like the architecture, construction industries where, you know, there's not really rights that are being retained by the taxpayer because they're giving away all the architectural, you know, plans and everything at the end, but they've retained the right of know-how, how to actually implement what you implemented for that client or customer for the next customer. So substantial is a little misleading here, and there's a lot of case law related to this specific funded area. Now, getting into software itself, software is one of my favorite areas as well because there is so much innovation happening and you always get to know about the new products and how things work. But basically, prior to 2015, a lot of software companies were not taking advantage of the R&D credit because the presumption was that all software was for internal use, like I mentioned earlier. Now that presumption has flipped, and the only software that is considered internal use is software that's intended to be for the general and administrative function of the taxpayer. So back to that question that was asked earlier about internal projects or internal process improvements, here's where you might run into some problems as well. If you can get over the hurdle of the activities being technological in nature, you might have to make an argument that even though the activities are internal use software, they still meet the heightened requirement test. The heightened requirement test means that you have to meet all 4 parts of the 4-part test that we just went through. And in addition, you have to show that you undertook the software development because there was no commercially available option for you, that the software itself was innovative in nature. This one's very subjective as well. Sometimes you get IRS agents who believe you, and sometimes you get IRS agents who don't. And then that the software created a significant economic risk by undertaking it. So if you have a company that's got 50 employees and you had 1 or 2 employees working on this project maybe 1 week out of the year, it's probably not going to hit that significant economic risk category. However, if you have that same company and you have 10 employees working for 6 months on this project, then that's significant economic risk. And again, this is very, very, luck of the draw here, depending on how aggressive or how conservative, the service will take on this. So a lot of room for interpretation with R&D. So now you know what qualifies in terms of activities. What I want to do is move into computing the actual credit. So how do you actually calculate an R&D tax credit? There are 4 buckets of costs that we look at. So we've established that the company has activities. Now we're going to collect financials. And what are we going to need from a financial perspective? We're going to need wages. So W-2 box 1 wages for employees. We're going to need supply information. So what supplies were used in first articles, or what supplies were used and wasted during the R&D process. We're going to want to collect any outside contract research amounts that were paid. The test here is if the outside contractor or vendor was an employee, would they qualify for R&D? If yes, then we can take them. There is a haircut that's given to outside contractor payments, and that is 35%. So we're only allowed to take 65% of those contract research amounts. Then there's this other bucket of computer leasing expenses that we can take. And in the 80s, when the credit started, computers used to take up like an entire room. And so the IRS said, okay, fine, we'll give you a break on all that cost for storing your computers and leasing computers. Now, as you know, we've evolved and you can keep all information in your pocket. So this has evolved into like a cloud hosting expense. So we see a lot of AWS, Amazon Web Services cost here. So what clients are using Amazon Web Services for is as a cloud environment to develop software. So any cost that's being paid to Amazon Web Services for development is this computer leasing bucket. So what you want to do is you want to gather all this information, and next we're going to calculate the wages. So how you calculate the wages is you take your project list that you had from the very beginning. You've established that you have a list of projects that qualifies under that 4-part test. Now what you're going to do is you're going to create nexus between the project and the employees. This is easier said than done. If you have time tracking, slam dunk, you can run a pivot table on your time tracking, and it'll tell you cleanly who was involved in what project when. For everybody else in the world that doesn't have clean time management or project tracking software, this is a experience. So I'm sure that everybody has seen, or maybe hopefully everybody has seen, like time surveys or other types of surveying employees to see what their time is. This is also why you don't want the CFO as your only point of contact when you're doing an R&D credit, because your CFO doesn't know what everybody's doing on a day-to-day basis. Talk to your project managers, talk to the folks that are actually involved in your projects, and see if you can't figure out a percentage of time that each employee was involved in each project. That is perfect nexus. Now, in every study, you're not going to get perfect nexus. So the next best thing, and what a lot of companies will do, is they'll just use estimates for percentages for employees. So we'll say, Gene was involved in this project 50%, Justin was involved in this project 50%, and Paul was involved in this project 20%. Now what we'll do is we'll multiply those percentages by their W-2 Box 1 wages to come up with your qualified research expenditures. So again, you've already established your QRAs, now you have to establish your QREs. And you do the same activity with your contract research, and you do the same activity for supplies. Supplies does get a little hairy, especially with manufacturing companies who don't necessarily track all of their supplies cleanly, and they don't necessarily categorize all their projects cleanly. So you might have to get a little bit creative on how you go after your supplies. A lot of times it's just matching the GL to POs. A lot of times it's taking the projects or new products and finding the actual literal binder that goes with that project through the manufacturing company and reviewing the notes that are on those binders to see what supplies were pulled out of inventory or prototyping. We have reviewed boxes of data under somebody's conference room before to try and find out what their tooling costs and what their supplies costs were. So it really depends on what your company has in terms of availability, but all three of these, same exercise. You essentially find a percentage for each and multiply it against the amount. Once you've collected your qualified research expenditures, you can then move on to figuring out if you want to qualify any pilot models. So there's this really fun case. Do you have another question for me, Paul?
Yes. Is it possible to claim R&D credit right after setting a new corporation as an initial year if the company would be expected to be eligible business nature for R&D credit? Then how and what might client need to claim R&D credit process? I think you mentioned it has to be about 3 years to be startup, so I'm not sure. So go ahead,
Yeah, so you need 3 years of base information, but that's a great question. I'm going to table that because we're going to talk about how to claim a credit for a startup company very shortly. But good question. So in terms of pilots, I just want to make everybody aware that sometimes there's the option to take the actual delivered good as a pilot. So there's this really famous case out there about a boat. And the question is, if you're creating a new boat, new size, new textiles, new shape, does that count as R&D? Because you essentially have created a boat before, but this is a new boat. So the argument, and the taxpayer actually won on this, was that, we don't know if the boat's going to sink or if it's going to float when we put it in the water. The entire boat could be a pilot. It could be your first run article. It doesn't matter that it actually ended up being sold to the client. All of the work that went into that boat was pilot models. So there's a lot of rules here, but I just want you to be aware that there's no requirement that the prototype does not get sold to the client. There are 2 different methods in California, 2 different methods in federal, and a lot of different methods throughout the whole entire United States for various states for claiming the credit. But basically in the federal credit, you need to establish which method you're using. The first traditional method takes into account average annual gross receipts. So it's always a moving target. You never know what data you have until you ask for it. So in the event of a merger or acquisition, or in the event of a company who's changed ownership or changed accounting, a lot of times you lose historical data, so you're not able to get the average annual gross receipts, or the credit's just not generating that high. So the alternative simplified credit was something that the IRS put in place that only looks at the last 3 years of qualified research expenditures versus your current year of current research expenditures, and it does a formula for that. So you no longer have to look at gross receipts. It is the easier method, and if you're trying to figure out if your client might have an opportunity, probably the method you want to use to estimate, but it just looks at 4 years of qualified research expenditures and how your current year is trending. For California, it's very similar to federal, and most of the states will be very similar to the federal credit. However, obviously the work that you're taking has to be done in that state. So similar to the foreign rules, think about every state as its own country, and all of the work has to be done within California, within Texas, within Oregon, whatever state you're claiming. California has not put in an alternative simplified credit, but they do have a second methodology. The federal tax credit does not carry forward indefinitely. It does carry forward for 20 years. California carries forward indefinitely. So if your client claims a California credit and then is unable to use that credit in the given year, they can carry it forward on their books indefinitely. And California does have a really cool extra bonus. So, you know, the benefit passes through to the shareholder and then they get a bonus 1/3 at the S Corp level. I just quickly wanted to show you guys the forms. Form 6765 is the federal form and Form 3523 is the California form. Okay, so I haven't forgot about your question, but we have a couple more things to get through before I get to it. But basically the next thing is documentation. So here is the key to all claims is documents. What documents do you have available to substantiate your claim? So at a minimum, we have to have financial backup. So give me the purchase orders or contracts that tie to your GL. At minimum, we have to have, you know, which are the projects or jobs that you're including in your study. We would love to have project documentation that highlights and covers all 4 parts of the test. However, especially in today's environment, we have a lot of chatting, we have a lot of real-time meetings, there's a lot of things that happen very fast where people don't document, and so we do the best we can in terms of substantiating the study. Depending on how big the credit is, depends on how you want to formulate your documentation or your documentation strategy. I've seen $100 million credits where every single document was logged, tied to a project and tied to a 4-part test. And then I've seen $5,000, $10,000 projects where you just dump some documents into a folder and call it good. And then maybe have to do some review if the IRS reviews your account. So it's very, again, subjective. There's a lot of gray and there's a lot of room for being creative here. So every client will inevitably ask, is this risky and what happens if I get audited? And I think the thought is like, it's too good to be true. You're giving me money back for the activities I'm already doing. How is this legit? And what I always tell folks is all of the big 4 do it. All of the big companies do it. You know, you might as well do it as well and get a benefit for the work you're already doing. However, there is obviously some sort of risk and the IRS does do a lot of audits in this area. There's actually a California specific audit group here. I think they're out of Laguna Niguel, and they do tons of these. So the things that they're looking for currently are project lists. So you have to establish that you have a permitted purpose. They look at base calculations and methods. Did you do the right calculation? What does your base look like? Did you include all the same information? There is something called the consistency rule, which I don't want to get into in deep detail, but basically you have to prove to the IRS that you have been consistent in your methodology for all of the years that you have claimed the credit. There is a lot of analysis around contractual relationships between clients and taxpayers and how that relates to funded research. The nexus activity that we talked about, ideally you'd have time tracking and everybody would be able to say what they're doing every day. That usually doesn't happen. And so how you develop your nexus between the people and activities is a big contentious area. And the IRS will typically pick the largest projects and make you show them the proof. So where are these employees? What are they doing? Where's the documentation to back it up? You can get creative, use calendaring, use all kinds of different tools. It's a little bit harder to go back, you know, if they're auditing 2 or 3 years after the fact, but sometimes, you know, you can hit a slam dunk and just find the best documentation. And then the California Franchise Tax Board will typically follow what the federal, what the IRS is doing. Okay, so there are some additional considerations I just want you to be aware of. For R&D tax credit purposes, control groups are treated as single taxpayers and control groups are 50% marker. So ownership of 50% or more common. There is a lot of crossover with like medical industry, especially. There's physicians or folks who are doing medical device companies usually have a couple different companies set up that do similar things, but different maybe industries or areas of specialty. And so this is something to consider. If you have to calculate a credit and you don't have information for a second company or a company within that control group, there's a way to do that, but it just creates a little bit more difficulty. So ideally, you'd want to do all of your R&D for the entire control group together. Obviously, short years and base years can get a little tricky when you have acquisitions, when you have short years, when you have people changing their calendar to fiscal. And then acquisitions and dispositions create some headaches as well. And basically, if you have that situation, you just have to make sure that you're consistent. So if you have a company that has disposed of another company, make sure you remove that company that was disposed from your base, including employees, supplies, contractors, all of that. If you have acquisitions coming in, you're always looking at the lifetime of the acquisition. Even though the acquisition came in 2019, that company had been established in 1989. We have to look all the way back to 1989. I quickly want to, because I'm running out of time here, I would like to hop forward to your question about new companies. So one of the great things that came out of the PATH Act was that companies who were qualified small businesses and eligible small businesses are now able to monetize the credit. So back in the day, the only reason that companies that were larger were claiming the credit and not smaller companies is because in your first 3 to 5 years, you probably are not likely to have some tax liability. Or if you do, it's not that much. So what do you do with the credits that you generate? Now what you do is you use the credit if you're within your first 5 years and you're under $50 million of annual gross receipts, you use the credit to offset your payroll tax. So again, thinking about cash flow for clients, this is a great opportunity for clients to save in the interim. I just did one of these this week. It was a client with 17 employees in the medical industry. Their wages were about 1.3 million. All they're doing is creating this medical device. So I was able to save them about $170,000 of R&D tax credit, which they use to offset their payroll. And that will be used over the next 2 years. So that's $170,000 of out-of-pocket savings that you're not paying. So in terms of new businesses claiming the R&D credit, you need the same exact things that you do for your other companies, with the exception of obviously you don't have that historical information. Yeah, I think that's all I got for you guys. Does anybody have any questions, or you've given me some really good ones already?
Okay, one more. Related to consistency, how much impact business has to consider for changing R&D credit firm? Also, new firm in general changes, many direction can cause more flags for IRS for audit opportunity.
Yeah, so I mean, I think clients change CPA firms and they change providers all the time. So the only thing you have to be aware of is if the company is doing an R&D credit, are they doing it correctly and is the process going smoothly? Ideally, like I have clients that have been with me for 5 or 6 years, those clients know what I'm looking for. And so the credit study gets smoother every year. If it's a challenge, or if you're seeing, like we see a lot of turnover, if you're seeing folks that aren't consistently getting the right treatment, or their credits are starting to go down, or their reports are starting to kind of look the same year after year, then you could consider a change. Acquisitions are always a really great time to change providers as well, because different providers will look at things differently. There is a few providers out there that have a very bad reputation with the IRS. I would say if you have any clients with those providers, maybe consider changing them as well. But it really is a situational. I have no right answer.
Okay, next question is, which presidency do you recommend most favor this R&D tax credit between Joe Biden versus Donald Trump?
Well, actually, it's always been a bipartisan credit. So both sides like this credit. I think in the 80s, the thought was we're going to stop sending jobs away and keep the jobs here. Everybody wants to keep jobs in America, including Biden and Trump. So I don't really think that there's a right answer there either. These are not easy questions, but I do think that there's bipartisan support for the credit. And we have seen a lot of taxpayer-friendly decisions come out in the last few years, and I don't think the credit's going to go away.
Okay, thank you, Lucia, and I appreciate your expert knowledge and experience, and
Thank you.
brought this presentation very, very alive, and I appreciate it. And in fact, we did ask a lot of questions. This is the most question that I'm
always available. I have folks calling me all day, every day. Does this company qualify? Does this company qualify? Is there potential? So feel free to pick up the phone and call me anytime.
Thank you so much.